I'm going to introduce the next introducer, and this is Bob Kopp. Bob is the associate director, one of the associate directors for the REI, and he is in the Blaustein School in the Earth and Planetary Sciences, and he studies sea level, amongst other things. So, Bob, it's all yours.
Great. Well, thank you, Paul. That was a wonderful big picture talk from Congressman Holt. For the next couple of talks, we're going to zoom in a little more closely to sort of the near term, and then zoom out again with Rob Sokolo's talk. So I'm very pleased to introduce our next speaker, who is Frank Napolitano. He is both an engineer and a banker, and is going to bring us a perspective on power and utilities. Frank is finishing up a stint as director of the U.S. Power and Utilities Group at RBC Capital Markets, and has a background that goes from an engineering degree at Cooper Union, business degree at Stern, stints at places like Chase Manhattan Bank, Hess Corporation, and Con Ed, and then his recent career at RBC. And his title of his talk is What's New in Energy Finance. Hang on, you can get it.
So what I did this morning is actually looked at the newspapers. I read 3 or 4 newspapers every day. Most folks in the financial community do. It's almost like the sports page of business. You got to kind of figure out what's the mood, what's going on where, what could it mean for today, what could it mean for tomorrow, what could it mean for the longer term. Could you bring that up on the screen, though? Thank you. I can see it, but they need to see it, too. So just a couple of headlines that I thought would be interesting, and then why, as I get into my slides, I believe it's relevant. And my remarks here today, even though I have a diversified background, so I've been on the science part of some of these businesses, clearly been on the business part of some of these businesses, and now I'm sort of in the banking role, which is more like an advisory and capital raising role. So in that particular capacity, my job is to somewhat be agnostic, almost like a sportscaster calls how the teams are playing on the field, and that's how I'm going to approach the money portion of the comments today. But a little bit about the mood. So one article is about, you may have heard that GE is attempting to acquire the power generation business of a French company called Alstom, which is a flag carrier for French industry. And as we know, the French industry supports nuclear power to a huge degree. It's about 90% nuclear in France. So why is GE thinking of this? I don't know. I'm not advising them on this point. But it could be because of some slowdowns in the core business as it relates to power generation here in the U.S., and they need to expand. And so there's been somewhat of a violent reaction by the French government. So the headline here in the New York Times is French government opposes GE deal for Alstom's electricity units. So there you've got international policy, you've got GE, and you probably have a change in fuel type that is occurring across the world. Next headline in the Wall Street Journal. Unloved in the US, dirty coal heads to Europe. Followed up in another sub-headline, dirty coal receives a warm response in Europe. I don't know if that was a little bit of climate change pun intended, but what it says is that just like thermodynamics, heat flows to where it's supposed to go, money does flow in the short term to where it thinks it's supposed to go, and in this case we're seeing resources flow to where they can make money. So if we're not going to use the coal here, it looks like Europe is welcoming the coal. So why is Europe welcoming the coal? Well, Europe was first into renewables, and as a result, they're now dealing with the financial impacts of the policy. And in countries like Germany, in Spain, they can barely afford, due to the recession and other financial impacts at the household level, they can't afford the high-priced power. So they're cutting back certain things. So this is all regards to renewable energy and increasing access to capital markets. I'm going to stay on this slide for a bit as it relates to these headlines, because what you see in this top 20 are a number of European companies, since they were the early movers due to social policy, to adapt climate change on a large scale, what I'll call a utility scale, in Germany, in Spain, in France, in the UK, and now sort of, since they're the lead parties that have some of this experience, they're now seeing that in recessionary times it's hard to pay for the power prices that are higher than they were before, and they're having to change. And that's why, in this case, the dirty coal is going back to Europe, because they haven't yet shut down the coal-fired power plants. They kind of just mothballed them. but they could bring them back on and make cheaper power than they can to actually honor some of the power purchase agreements that they'd entered into for the renewable power. So going back to France, here's another headline. So Siemens was being welcomed in by France to take over this Alstom power generation business so that they could keep it European, as opposed to GE, which I say is a US company but a global multinational. And now Siemens is forced to respond. So whether they're going to buy Alstom or not, they now have to talk about what their power generation strategy is. And so now they're out talking about transmission and central stations again, in addition to the fact that they are a solar and a wind manufacturer of equipment. Next headline I thought was interesting this morning was again about Ukraine. So for those who aren't aware, Ukraine gets a lot of its natural gas from Russia, as does lots of Western Europe. So when this Ukraine issue first came up, you heard about the US LNG business jumped onto this, liquefied natural gas. Like, why don't we drill more via fracking, produce more natural gas, turn it into LNG, ship it to Europe, and provide our allies in the West with energy security, that they're not dependent upon Russia for their energy. So that will come and go. But the experience of Russia, quote unquote, turning off the gas valves for Ukraine and Western Europe is seasonal. It had happened every year in effect because they wanted more money for the gas, and they were getting more money for the gas. And so the economics on LNG as they stand today could work, and that could lead to lots of activity here in the US if policy permits it. Another headline about Europe, because we have some of the Spanish and Portuguese companies here. Europe sees lower inflation, so folks may have been reading about deflation or the lack of inflation. And in Europe, they are experiencing deflation. I would argue we are also experiencing deflation here, but for the fact that we're changing the value of our currency and we can't currently see it at the consumer level, but eventually it will matter. So in the case of Europe seeing deflation, since their economies aren't growing, their companies can't grow locally, and they're seeing financial stress as a result of stretched balance sheets, both at the company and the consumer level. So a lot of these European companies, so for example, number 2, Iberdrola is a Spanish company. Number 3, EDP is a Portuguese company. Number 5, E.ON is a German company. Number 7, BP, clearly a UK company. As I go down further, we kind of get into Infigen, number 15, is a UK company. So they're going to start selling assets. And so since they had this experience of the early mover advantage of producing utility scale renewables, typically PV solar and wind in Europe, they then came over here to take advantage of our policy change and get on the front end of that curve. And they built probably majority of the capacity initially. Now they own these assets, they're cash flowing. They don't have enough money back home to take care of their balance sheets. So this is creating an M&A wave. So they're going to sell these US assets to whomever, private equity companies, US companies, in order to repatriate the cash to pay down debt on the home balance sheet back in Europe. So we're seeing a change in the ownership of assets of this type, and it's tied to global economy. Another headline in today's paper, adapting to Chernobyl. So we all know that was a terrible accident, as was the tsunami impacts in Japan. So nuclear power is still always a headline, and yet it has that other favorable headline, which it is also carbon-free, a generation that produces baseload capacity. And we need it. So currently in the current energy mix at roughly 20 to 25% of our power, coal roughly 35 to 40% of our power currently. Next headline's about Berkshire Hathaway. So this past weekend was the annual meeting for Berkshire Hathaway shareholders. So they all go out to Omaha, and it's a big sort of jamboree, and you get to shake hands with Warren Buffett. And no surprise, Berkshire Hathaway is heavily invested in the power and renewables industries on a global basis. They own UK utilities, they own multiple US utilities. They're a large investor, as we see them on this list here, known as MidAmerican Renewables. That's a different name for it, number 10. Just a couple of days right before this annual meeting, they renamed their energy activities from what was called MidAmerican Energy to Berkshire Hathaway Energy, so that there's no doubt whatsoever that it's their name on this strategy and they're standing up for it. So they have been building and buying utility scale solar plants, wind farms. They've been doing it in rate base. They've been doing it in the competitive markets. They've been financing it with debt and equity. And it's a strategy that's working for them. And oh, by the way, because they're such a big and profitable company, they have a lot of net income that they could buy Shield for, and one neat way to buy Shield if you're a corporation is to invest in renewable power, because unfortunately the way this all works in the US is renewables and tax policy, leave social policy and other monetary policy aside, renewables and tax policy are as married as any couple could be, which causes some complexity. The last headlines I'm going to kind of read here, and then I'll kind of segue into the comments via the slides, are about bond yields. So I talked a little bit about macroeconomics, microeconomics, people who can and can't pay for their debt, folks who want the social policy for the non-carbon power, but now that it's all coming home to roost that you have to pay for it, what do we do about that? So there's really no one answer, but there's just an awful lot of swirling circumstances. And the one that kind of gets me is a headline about where is U.S. monetary policy as it relates to our deficit, our borrowing costs, and how debt is performing. So here's a headline from today's Wall Street Journal. Stubborn, it's always emotional as you read these headlines. Stubborn bond yields touch a low. So from the writer's perspective, maybe that's good, maybe that's bad. From our perspective, we may have the opposite perspective. But the point is that the 10-year Treasury, which is the global benchmark for yields, for which, in my personal opinion and my 25 years of experience, all other risk capital then trades at a premium to what that 10-year risk-free rate is. Currently, that 10-year Treasury closed yesterday at a 2.566% yield. So we have been seeing very low Treasury yields, which also means the U.S. has enjoyed, during this period of record borrowing, very low borrowing costs for quite a sustained period of time. And we're now getting to a point where the economists can't make sense of it any longer. So when folks that are expert in these fields, whether it's energy price or policy or economists, see something that is a trend that doesn't make sense, maybe climate change is one of these trends, that don't make sense, generally events occur, and they occur not in a smooth continuum, they generally occur in a violent whipsaw step function. And so the view on Wall Street for years has been, when are the borrowing rates going to go up? And therefore, when are all the other forms of risk capital going to re-equilibrate in terms of their supply, demand, and value? And what will that mean? So in a large way, I believe the investment community, which is you and me on our personal accounts, indirectly you and me if we enjoy the benefit of something like a pension, as those pension fund managers may invest that money on our behalf, and or we always have to keep an eye on the federal government, because if they need money, they're going to come back for it as they have to, and the only way they can if borrowing isn't an option, which is taxes. So we kind of have to keep this all in balance as we try to plan ourselves. So that just kind of adds to the complexity of how do companies sort of plan through all of this change. But as we get to this 10-year yield, I'm going to give you one Wall Street stat. And for every year for the last 3 years, as I recall, the greatest brains on Wall Street have been saying that 10-year yield by that year end, so they said this in 2010, they said it in 2011, they said it in 2012, 13, I can tell you 14, they said it again, that yield was going to absolutely be, by the end of that year, was going to be 4% or greater. And we're going the other way. So in a market where, which could indicate people are uncertain about the climate, and therefore they're going towards a risk-free rate, they don't want to take a chance of capital loss, so they're investing in treasuries or they're investing in corporate debt. But what that 10-year yield means, again, let's just call it 2.5 or 2.75%, is that the borrowing costs for anything you might want to borrow. You want to borrow to buy a house, you want to borrow to buy a car, you've really never seen lower rates. So that permits a lot of buying, but we really haven't seen the buying, which is part of the issue. So where does that all come home to roost in utility land? Well, let me just pick one company, which happens to be number one on the list, NextEra Energy. There was a headline last week where they talked about breaking up off their renewables business. They have the largest, as we can see here on the pages. And they are diversified into hydro, wind, solar, geothermal, et cetera. And they're going to break off that piece of their business and create a separate public company. And that separate public company has a term of art on Wall Street right now called a yield co. So the yield indicates that it's going to pay a dividend. And they gave it a fancy name because it's going to pay a dividend better than, higher, i.e. higher than, anything else you can buy today, which is kind of good for renewable power. If a renewable power company can say that I'm rewarding investors better than any other company, then they can attract more capital and keep doing the same thing. Well, the underlying assets are the important part. The underlying assets of these yieldcos or renewable power companies are contracted utility scale proven technology power generation equipment, whether it's wind farms or PV solar. And so that's now viewed, in the beginning, 10 years ago, it was not viewed as mainstream, main scale. It is now, so much so that those things as building blocks can feed into things like companies that can form public investor bases and continue to attract capital and become a self-fulfilling prophecy. But the key punchline, and I'll get to it in a second, is that if those contracts, meaning what that means is that a regulator has allowed a utility to sign a contract with a third party where the utility is then going to buy that power and then distribute it to its customers, which are us, ratepayers at the end of the day. And as I said before, that all worked in Spain and Germany, et cetera, until folks started to see the pancaking of that bill and didn't want to pay the bills any longer and stop paying the bills. So NextEra, unfortunately, has one of these examples. So they are currently 75% of the way done building a complex technology, solar thermal with molten salt storage in Spain. The only reason that they started to build this $2.5 billion project was because they had a long-term power purchase agreement to sell that power. And that power purchase agreement was lucrative enough to finance all the risks associated with merging all those technologies together, and then allow somebody like NextEra to go out and build it. 3/4 of the way through the construction, what did the utility on the other side do? They said, we can't afford the power, so we're abrogating, which means canceling the contract. We're not going to pay you for this power. So what does one do when they hold a contract that's valid? They go to the highest court in that land, which is the Supreme Court equivalent of Spain, and Spain said, our company cannot afford to pay for this power, and we're just not going to apply the law. So you can see how when risk capital needs to flow, you have to have comfort that you have something in your hands that you can depend upon. And so when you have something like that happen in Spain, it could now happen in Germany, it could happen in France. Maybe it could happen here, because this is what's happened before. The last time energy policy tried to change with a fuel switch was really to get off of fuel oil as a baseload fuel to natural gas. And a new wave of power producers came in to build all these gas plants in the late 70s and early 80s. And then the power prices went up, and the contract got abrogated, and bankruptcies occurred. And the hardware got built, but the commercial promise was broken. So markets really care about all of those headlines because they have to see through, not just to that piece of paper that a Supreme Court someplace can say is no longer valid. They have to say, does this make sense? Does the political will, the social will, the economic sense, the proven technology, does this all come together so that at the end of the day, I'm doing the right thing for my shareholders who are investing in my stock to make those judgments? There we go. Great. So I talked about the M&A market occurring. So no surprise, and Rachel Schwam was very helpful to me on these slides. So Rachel, thank you very much. So in this case, these are three recent wind farm sales. So EDP, a Portuguese company. Invenergy is a private company based in Chicago. And there we go, EDP again. So it's no surprise, like I said before, that EDP is selling stuff. And they're selling stuff that's worth money. And look at the buyers. Borealis is a pension fund for the province of Ontario. Caisse de Depot is a pension fund for the province of Quebec. And Fiera Axiom is a for-profit infrastructure fund headquartered in Toronto, in Ontario. So here we have Europeans selling and Canadians buying. And these are all nice cash flowing assets, so it kind of makes sense for both parties. Same is true in solar. BP, they once had, before the whole Macondo mess, BP stood for Beyond Petroleum. So they were a big investor in solar and in wind. And one of the early big movers, that's not a strategy they can afford any longer if anybody saw 60 Minutes on Sunday night. So Sempra is a US utility based in San Diego, who brought in some private capital from Goldman Sachs. And we all know Con Ed here in New York with Carlyle Group. So the segue here is that before we had the Canadians on the pension side, and now here we have private equity. So private equity is seeing this opportunity to take advantage of buying cash flowing assets. And now why does that 10-year bond yield matter? So if the risk-free rate is 2.75%, and I can invest in the equity of one of these contracted solar or wind farms and earn 10%, I'm almost earning 4 times the risk-free rate in a risk-reward that looks pretty balanced. I've got proven technology, I've got credit-worthy counterparties on the other side of those PPAs. The only thing I have to hope is that the political will doesn't change when the rates go up through the pancaking on the bill, and I can hold that piece of paper in my hands and possibly bring it to the US Supreme Court for adjudication. So we've heard a lot about social support and political will. Clearly that has created the U.S. renewables business, and that business is thriving in many forms. But so far I've talked about proven technologies. I'm not here to delve into emerging technologies. It's not my area of expertise, other than that's more of a venture capital area, and there certainly are venture capital dollars spreading into all of the areas about what may change this whole energy paradigm. But as it compares to the dollars that flow in the mainstream business, it's a lot smaller. I guess the idea of a room like this is to get folks together and figure out how can we make that bigger, and how can it make an impact. But clearly success breeds success, and if some of those emerging technologies prove to be successful, more money will flow. So the bottom point, I want to get to the institutional investors. So, for example, the state of New Jersey's state pension fund is an investor in power and energy in a variety of ways, as are public securities investors. So folks are all measuring this risk-reward balance. And as it relates to the yieldcos that I mentioned, there's been an IPO wave, initial public offering wave. So that they have been successful in 2013. There's several on the road right now to be sold in 2014. And that looks pretty good. It's a good time on Wall Street for those kinds of issuers. So I'd like to maybe take a second and see if there are any questions about that portion of the presentation, and then I'm going to go into somewhat of a segue on how all of that isn't necessarily a reward to the existing model, but is somewhat of a risk to the existing utilities and how they think about doing business, because they can be, for good or for bad, in all this transition that's occurring. There's a mic coming your way.
So thank you. Just to clarify for a simple-minded, non-financial mind, I kept listening, so are we hearing good news or are we hearing bad news? So I heard that, the Europeans had maybe overreached themselves with their renewable portfolio standard type legislation, and they now couldn't afford the kind of power that and the contracts got abrogated. But at the same time, long-term, smart investors are buying up these assets, so they are betting on them being a good deal. So can you just break
Sure.
it down even a little bit more?
Sure. It all depends on your perspective. So from a deal flow or deal occurrence or activity, market activity standpoint, for a banker, it's a good thing. For a buyer, it's a good thing. For an investor, for example, if you're going to take $1 out of your pocket today and buy one of these companies, it's a tricky thing. So you're likely going to flow your money to the place where you currently feel, all things being equal, the rules are fair, and people will do what they say they're going to do, in simple terms. And thus far, the U.S. has been fine. But I always have this but, big but, B-U-T, in the back of my mind, because I have seen these transitions before, and they end in bankruptcies. The deregulation of natural gas in the 80s, bankruptcies. The deregulation of electric power in the 90s into the Enron cycle, bankruptcies. The end of nuclear power construction in the 70s, bankruptcies. So competitive retail. So for example, if you're a New Jersey consumer, you can buy your power commodity or gas commodity from competitive parties. You don't buy it from the utility. Utility transports it, so you pay them a service charge. But you can go and shop. This recent polar vortex, bankruptcies. So that word keeps coming up. California power crisis in 2001. I know a little bit too much about this. It's not necessarily all the trading that occurred. It had to do with flawed market design towards trying to get consumers to choice. And that was just, it broke. It broke at the wrong time and got exploited, and that's where the trading issues came in.
So what would be the U.S. equivalent of backing out on?
It would be a public utility commission looking back on a contract that they previously approved as fair, reasonable, and in the convenience of public necessity, and saying, we changed our minds. We're not going to order our utility party that we regulate to recover those revenues. So they stopped paying the price. If I owned the solar farm and I no longer get revenues, or I'm selling at some lower market price, what do? I turn to my debt holders and say, sorry, don't foreclose on me. So that could lead into bankruptcy, and then that asset, revalued at a lower price, feeds right back into the M&A market, and maybe it gets bought by one of those yieldcos, maybe it gets bought by private equity.
M&A is merger and acquisition.
Mergers and acquisitions, sorry. Mergers and acquisitions. There's a question right behind you.
Thanks. My issue is about demand for the products and the divestment movement that I've heard a lot about. And I just also want to put a website out there. It's called pushyourparents.org. So because in case you don't have a pension, obviously your parents and grandparents might. And they could try to invest in energy companies.
Sure. Now, are you talking about demand for commodity? Because I'm going to get to that in a second. If you're talking about demand for the renewable assets?
No, just the role of individuals in their pensions and like
Oh, sure, to create
a
change in that
demand for
regard.
the
Yeah.
product.
Well, you know, that Fieri axiom was a good example. So that fund solely exists with private capital. So again, it's folks like us, probably better off than us, who are signing up to write big checks to a manager who's then going to go buy assets of that type. But in their charter, all they can invest in is renewable power assets. So there's a marketplace for specific targeted investors in the private equity community to play in that regard. In the public example, it would be, so for example, I had NRG on that list of 20 before. NRG carved out their contracted business, call it their contracted renewable business for simple terms. And so if you wanted to support their strategy, you would buy the common stock of that company versus their parent who owns a whole lot of carbon-intensive fossil assets. You might buy both, depending what you prefer. So there's plenty of individual choice, even down to the individual level. You know, a share of NRG yield is $40. So folks can vote how they like with their investment capital.
So I think we have about 8 minutes left, so if we maybe refill that. We also will have time. Heather Zeichel, unfortunately, was not able to make it, so we will have a panel at noon, so that we
Sure.
have more time for discussion then.
Okay. Well, you know, the last part's a lot less interesting in my opinion, but it's probably a lot more impactful, which is you know, change. Who likes change? Probably nobody likes change. And so change is coming again. So I remember that I used the word bankruptcies maybe 5 times just a few moments ago. That all impacted the utility sector because the utility sector is a mixture of policy and business due to the regulated monopolistic nature of the business. And disruption is coming their way. Now the disruption could be economic and commercial, but the disruption could also be technical and physical. And ironically, that's where the renewable assets and distributed generation and microgrids, all themes kind of swirling around at this very same time, are presenting technical issues to the grids. So for example, the sun shines during the day. That's when solar power makes power. Generally in the places where wind is built, that wind spins at night. So that kind of looks like a nice mix, except it's never perfect because the peak load is generally in the interim periods when the sun is going down and before the wind picks up. So something's needed in the middle. And storage is a big thing. It's the holy grail. We get that right. We can probably retire a whole lot of inefficient or polluting power plants. But in the interim, we kind of need it all as we work from this central system command and control model to a very democratic, dispersed choice where me at the consumer level wants to control my own power policy. I think it's going to get very involved when folks sort of go down that road at that individual level because they're going to see the complexity of trying to make sense of it all and balance it all. And invariably, we will have spent more to get there than we wanted to. And then somebody's going to have to seek recovery of that capital, and then that's where the political risk comes back in. So the investors in the sector have seen the play before in multiple different iterations. But from the utility standpoint, some of them are taking a position on disruption to say, if this is the way it's going, I want to get on the front end of it, like that NextEra example, biggest one in the world. And some are clearly, if you're too small and you don't have the capital to get on the front end of it, you're clearly going to dig in and fight it as much as you can to make it impact you as little as possible. But the disruption is generally around, the first key one that impacts our sector is demand. So post the recession, as a whole, countries using less power, fortunately, every year. Some could say that's a good thing. We're not emitting carbon emissions associated with the power we're not producing, but it's also a sign of, I'll let you judge, are we in good economic times? Generally, the post-World War II generation had been that for every point of GDP, power consumption in this country had gone up a half a point. We're now seeing the opposite side of that curve. So when folks talk about the economic recovery, and they call it different, and they start inventing words because they've never seen anything like this before, and they don't know how to articulate it, you can go measure that bond yield and say, wow, we're at really low borrowing rates. What does that mean? People are afraid of the future. But the fact that demand is going down impacts how the commercial model of power and utilities work, because it was a throughput model. The more you use, the more units of production there are, the more units of consumption there are, and the cost can get spread over those more units, and people notice it a little less. But when it's the other way around, people notice it a lot more. And so that's leading to individual energy conservation. I shut the lights in my house all the time. And at the commercial level, energy efficiency. So all of these things are equating to less demand, which is okay, except then you got to look at all the assets that were put in the ground at a time of higher demand and say, how do we commercially transition those assets without bankruptcies to get from the period of time when they could pay for themselves to the future where they may not be able to? And maybe it's just going to be bankruptcies. I don't know. But that's where the betting public has to take their chances.
What's the y-axis there?
I'm sorry, you know what, I threw that graph up and I have no idea what it is.
That's demand. It's a unit of demand.
I think it's in terawatts, right?
Yeah.
No, it's percentage, year over the previous year.
So the Swiss patent clerk was mentioned before, and the quote that I like that he said is, "Why remember something you can look up?" So I'm sorry, I don't have that up there. So we talked about retail choice. Retail choice was a great thing in declining commodity prices, which we saw with decreasing demand. But then we get something like the polar vortex, and prices spike up, and people go through working capital issues. So I'm not so sure how this is all going to shake out for retailers into the future. Clearly, we've got a lot of gas and the potential to get to a lot of gas in this country. That's a huge policy question. If one looked at the natural gas price curve over time, it would appear that there's no inflationary characteristics to the price of natural gas. And if you were a large industrial consumer of natural gas, you could lock in 10 years of natural gas at a very attractive rate. Those are not liquid curves, so it's not very transparent price points. We really don't know what the out years are going to look like. But what we did experience in this past very cold winter is record utilization of gas. So as measured by how much gas is in storage, because what we do is we use it during the winter, we produce it during the shoulder periods, we use some of it for the air conditioning load during the summer, but generally we try to get ready for the next winter because it's largely a heating fuel. And we are at record low storage inventory, which means that if we can't produce enough gas to refill the storage, when we head into next winter, we're going to be looking at volatile up gas prices. And as we start to retire coal plants for whatever reason, and we build more gas plants like we're doing in the PJM area here, and those plants are dependent upon gas prices to make money, you're now having large consumption in power gen for gas, you're having large consumption in heating load for gas at the same time, i.e. polar vortex conditions, which means spiky kinds of volatile prices and more uncertainty as to how markets are functioning. So this is all kind of coming home to roost in real world examples in a very short period of time. State regulatory models are going to have to sort of decide, are we going to allow the old things we built to transition to the new world in order to achieve the distributed generation ethos? And more importantly, for electric utility investors, return on equity is a measure of the profitability of their companies. And if those numbers are going down, they're going to have less profit by definition. And they're going to have investor changes in their mix because folks are going to sell the stock. Environmental, we've talked about at length. And this is kind of a last hidden one. Utility workforce is getting older. So with all the physical work of installation, maintenance, big transmission line build-outs, et cetera, it's more likely than not that it's quote-unquote not the utility that's doing this work anymore. They're outsourcing it in an outsourcing model. And that has complexity as well. Transmission, energy efficiency, demand-side management, and distributed gen. We've really covered most of this. If we can solve storage, if the brain power in this room can add to the storage solution, we can make a lot of progress. So thank you.
So, thank you, Frank, for a very fascinating talk. I certainly learned a lot from that. If we have time for one burning question, we can take it now. Otherwise, we will have a discussion at the panel at noon, and also Frank Felder will be giving our next talk on disruption of the utility sector, so there'll be a flow to that. And Paul.
Frank, I really enjoyed that. I have one simple question because you followed Rush Holt's talk. Does any of the investment in renewables is it directly related to concerns about climate change, or is it just simply based on a business model?
Business model cash flow.
That's it. So where does the role of climate change at all have any influence on the investment structure?
Had something called carbon cap and trade passed, it would have a direct impact on
So
it.
that is the key. So the carbon cap, in other words, the cost of carbon, the air shed is free right now, right? If you put carbon dioxide into the atmosphere and it's free, you don't really care.
Well, you care because if I'm like I said before, you can buy a carbon company or you can buy a renewable company. So if the individual investor starts to care, they'll revalue the companies and tell people how to behave.
So it's a price on carbon. Price on
It's
carbon.
one aspect of it, sure.
Very good. Okay,
Yeah.
thank you.